Right, hi everyone. My name is Richard Perry. I'm the market analyst at Hantec Markets, and I do a monthly webinar with FX Street. In this one, I'm going to be talking about economic growth and the impact that it's having potentially on the markets. It's pretty pertinent actually in the current environment, because the Fed has certainly sort of highlighted that economic growth is one of its key considerations in the next Fed in its next rate hike timing. So this is why economic growth, I think, will be, or the indicators of economic growth will be keenly watched in the next, certainly in the next few weeks in the run up to the next Fed meeting. And it's sort of quite a good idea to, I think, probably talk about it today. So what I'm going to do now is just share you my screens, because I've got some slides for you. So here we go with the slides. I hope everyone can see them. And just before I start, I'm going to just briefly talk about the disclaimer, because I'm going to be talking about live market information. I'm going to go through the slides for about sort of 20-25 minutes, and then get onto some live market analysis, looking at sort of the Forex majors and commodities and indices. So yes, you should read and understand the disclaimer, because I'm going to be talking about live market information. The sort of the list of what I'm going to go through today, as I said, through a bit about growth, a bit about theory of growth, OKUN'S law, which is the link between growth and unemployment, and the indicators that you need to be looking out for on a monthly basis. How these announcements actually impact on the markets as they come out, and I'm going to then go on to do a bit of technical analysis of the markets. So basically, there are starting off with the theory side. I mean, there is sort of quite a lot of growth indicators out there and are released on a monthly basis, and they'll sort of form a picture of how the economy is performing. Probably the most widely watched or followed indicator is obviously the GDP, the gross domestic product, but there are other indicators such as the PMIs, which are now taking on an increasing importance for traders. Now, economic growth is important because it's seen as the primary way of measuring the strength of an economy, and therefore the central bank will be very much looking at economic growth as a gauge, and it sort of certainly feeds into monetary policy settings, although it may not necessarily be part of the mandate. I mean, certainly the Fed's mandate covers inflation and unemployment, but not necessarily growth. But the growth data will have a direct impact on both of those economic data points. So the Fed and other central banks will certainly be keeping a close eye on growth numbers. Now, the theory would be the virtuous circle versus the vicious cycle. The virtuous circle being if you can grow the economy, therefore you're producing more, it's going to lead to employment growth, that's going to drive consumer spending, and it's going to again feed back into economic growth. So that's the virtuous circle. But the opposite of that would be whereby you start to see the slowdown. You see unemployment rising, people have less money to spend, they don't spend in the shops, therefore consumer spending goes down, economic growth suffers, and it sort of enters into a cycle of reversing the economic growth that had been in place. So it's very important, economic growth, in terms of how the economy is performing. Now, as I said, OKUN'S law is an economic theory which seems to ring quite true, doesn't it? If you look at this this chart here down the bottom, basically OKUN'S law suggests that a 1% increase in unemployment would cause a 2% decline in GDP. So basically, if unemployment's going up, then growth is going to be negatively suffered on the back of that. So subsequently, you want to see unemployment falling, and therefore that will help to drive growth. I mean, it's, as I said, that feeds into the whole virtuous or vicious cycles that I just talked about. So this is the chart that was used as empirical data, and there's also a coefficient called the OKUN'S coefficient. basically means the more flexible the labour market is, the less of an impact the changes to unemployment are going to be. So if you've got a much more open economy, much more open labour market, flexible labour market such as the US, UK, and sort of Germany, I suppose, you've got a much more the economy will be able to sustain a hit of unemployment much easier than if it's a closed market. So that's the Okun coefficient. But certainly Okun's law does have an impact on the Fed policy, and that has been certainly documented in the past. Again, that sort of feeds into the whole sort of process of why growth actually impacts on the economy. You've got here the stronger growth leads to better consumer spending, improved economic confidence, improved employment, and also the key one at the bottom, stronger inflation expectations. Now, inflation expectations I've spoken about previously. They are a significantly primary impact on monetary policy. And if stronger growth leads to stronger inflationary expectations, therefore that leads to expectations of tighter monetary policy. And that is the crux of it, because ultimately what central banks are looking to do is they're looking to generate the Goldilocks scenario. They're looking for strong growth, but with stable and positive inflation. But if that growth comes in incredibly strong, then that sort of is going to drive up inflationary expectations even higher, and that may lead to the central bank having to increase interest rates at a quicker pace to try and sort of stave off the threat of high inflation. Now, at the moment, obviously, central banks are really struggling to generate inflation around the world anyway, and growth. So there's not really an issue at the moment. Obviously, still central banks are tending to remain on the easy path, although the Fed is clearly sort of trying to move towards a tightening. Well, it is started a tightening cycle, but it sort of is trying to push ahead with that cycle. And now the Fed, in the last Fed meeting minutes, if you sort of read them, suggested that economic growth needs to be sort of gaining traction as well. They sort of want to see economic growth in Q2 continuing to improve, and that would help to sort of drive the inflationary expectations, and that would help to sort of persuade them to tighten monetary policy, or in their case, normalised monetary policy. But certainly that seems to be still the case. So the economic indicators that we're going to be looking at, GDP is the primary one. Sort of looking at quarterly. That's a quarterly reading. It is notoriously subject to revisions, but primarily we sort of obviously focus on US and now China as the sort of drivers of market sentiment in terms of the reactions for GDP, because basically GDP is backward looking, but despite the fact that it's backward looking, it still is a big sort of indicator for how an economy is performing. So the market will still pay it a lot of attention. You do, as I said, get 3 separate readings, and certainly the first reading will garner the most reaction. But subsequent readings do also get important moves because of potential for revisions, and certainly the US data has been notoriously sort of subject to revisions, certainly in recent quarters. And again, the first reading of GDP in Q1 was, I think, 0.5. It's now got up to sort of 0.9, I think it was, at the second reading. So there is a big tendency for revisions. The other economic growth data that I'm going to be talking about is for the PMIs. Now, the PMIs are a forward-looking data point, so they do get, or they are getting an increasing sort of focus for the market. Now, they're important because they are pretty much the first data point that's released on a monthly basis. The manufacturing data is released on the first trading day of the month, and then a couple of days later you get the service sector data. So both readings paint a very strong picture of how the economy is sort of looking at the current state. Now, because obviously GDP is backward looking, markets take an increasingly sort of strong look at the PMI data as well. You've got also other data points that are worth focusing on. Industrial production. Now, industrial production, for example, in the States accounts for about a quarter of the economy, so it can be a strong indicator of future growth. Within that, the capacity utilization is also very interesting because that shows how much or the degree of industrial capacity that's currently being used. So obviously, the higher the degree of capacity, the more sort of the economy is functioning efficiently, and it is sort of firing on all cylinders, as it were. So you want high industrial capacity utilization. I'm increasingly looking at the Fed surveys actually. Now let me just show you the Fed surveys. Oh, before I get into that, here's the ISM manufacturing data for the US. And this is interesting because it's actually fell last month, and it's actually expected today. It's actually coming out today at 50.4, which would be a second month in decline, and not a million miles away from 50. So, I mean, with the Fed considering to hike interest rates and wanting to see continued traction in economic growth, is that really an argument for traction in economic growth if you've got the manufacturing PMI at 50.4? I suppose the argument would be the service sector is the bigger data point, and that actually has been rising for the last couple of months. This is the ISM non-manufacturing, and it'll be interesting to see how that comes out on Friday. But I was going to talk about the regional Fed PMIs because these are all basically what you get is the regional Fed banks will come out with or do surveys of how their economies are performing, and as you can see, or below zero suggests below trend growth. So New York Fed disappointing, Philly Fed disappointing. Richmond is pretty much the only one actually that looks positive. Dallas Fed looks dreadful, and the Kansas City Fed looks dreadful as well. So you've got all these regional Fed surveys that still look pretty dour, and yet you still are seeing the Fed sort of the Federal Reserve actually sort of pushing towards a rate hike. But these Fed surveys do not necessarily suggest that the underlying economy is all that strong. So it's very interesting that that is happening. But those regional Fed surveys do get a lot of attention and certainly do move markets as well. So let's have a look at GDP. As I said, it's the primary gauge of an economy, really the economic growth side of an economy, and it's the total amount of goods and services produced by the country, and it's calculated across the year. You get sort of percentage changes from one year to the next, and certainly is used by central banks. You get three separate readings, as I said. Now, the first reading accounts for about 40% of the data, so less than half of the data is actually been used in the calculation of the first reading of GDP. So it's subject to significant revisions a lot of the time. Second reading about 70%, and even the third reading doesn't take into account the whole amount of data, and after that, when you get the next quarter being announced, you'll often see previous quarters being revised as they sort of get the full gauge of how economic growth is performing. Now, GDP does have a significant impact on financial markets. Certainly, the local currency, local bonds, local stock market will certainly all be impacted. here we go with, I wanted to show you the this chart here, because these grey bars are basically where GDP currently sits, and the green bars are the extension of that into 2030, so the next 15 years. So you can see that in the next 15 years, China and the US absolutely swamp the rest of the world in terms of economic production. You can even see India, which overtakes Japan as the third largest economy in terms of economic GDP. Brazil remains high. Brazil is increasing. Germany remains high. UK overtakes France, interestingly enough. It is significantly showing that this is the reason why the market takes such a huge interest in not only the US but also China. So China GDP going from around about half the US GDP catches up very quickly, and you can imagine, I mean, I haven't done the calculations, but you'd imagine by sort of 2035, 2040 that China probably would have overtaken the US in terms of the largest economy in the world. But the markets will take a huge interest in both GDP announcements, because risk appetite, because so many economies feed off, certainly China. I mean, just all the tiger economies and all the emerging economies of the Asian Pacific region will run off China a lot of the time, Australia as well. So there is a significant interest in China as well as the States. And onto the PMIs. Now the PMIs are, as I said, their surveys. It's a monthly survey of the purchasing managers of companies. Now, the purchasing managers are sort of have to take the key decisions in terms of what the company is going to do going forward. So they will be sort of finger on the pulse in terms of how the economy is, or how the sort of business sector is sort of looking at that current point in time and sort of for the near future. So they are a very strong lead indicator, these PMIs, in terms of how these sectors are performing. Now, the questions that are compiled by these surveys sort of take on sort of 5 different factors. You're looking at production, new orders, which is very important, supplier deliveries, inventories, and also employment as well. So there's all aspects of that sector. So when you look at manufacturing PMI, it's a very strong lead indicator as to exactly how the manufacturing industry will be performing in the near to medium future. The surveys are compiled by a lot of the time by economic data information group called Market, and they run PMIs across sort of 30 countries. You've also got the ISM, which is the Institute of Supply Management in the States. And for the Chinese PMI data, aside from the official government data, which is sort of arguably questionable, there's the Cajun data, which is the unofficial data. So so the PMIs are basically taken to be a forward-looking leading indicator, and that's why the FOMC and other central banks will look at them and will look at them when they consider monetary policy. So, for example, the US today PMI for manufacturing is going to dip to 50.4. As I said, that's not necessarily a great indication of the manufacturing sector in the States. Now, the US at the moment is running an industrial sector recession. So they still need to see that industrial sector turning around, and a hike in interest rates is not going to help that whatsoever. So very interesting that they're looking to do that. Now, in terms of reading the PMIs, you're looking at 50 is the neutral level. It's above 50 is expansionary, below 50 is contractionary. Now, you've got here the charts of both China and the US. Now, the US is up to date pretty much. As you can see, the PMI line. This is the all sector PMI, which actually takes into consideration both ISM, which takes into consideration the manufacturing and service sector PMIs. in the States. And according to Market, which is not the ISM data, by the way, Market's data is different. According to Market, the PMI has been falling and is again falling back, and doesn't look all that great for growth, does it? I mean, you can see that how economic growth, which is the light blue boxes here, does track where the PMI has been, and it's falling at the moment and has been falling throughout 2015. And we're basically hiked rates basically here, didn't we? And then PMIs are well below there, almost at sort of 2-year lows, aren't they? Let me just show you that again on the. So this is the manufacturing around sort of 2-year lows, and the service sector again, the non-manufacturing PMI ISM is again well below the 2014 and 15 levels. So the PMIs are not all that great for the forward-looking sort of outlook for the US economy. But despite that, the Fed is perfectly happy, seemingly, to sort of push towards hiking interest rates. Okay, so how do these indicators impact on the markets themselves? So generally, as ever with all this data that I've been talking about, the stronger the data, the stronger the impact for the local currency, the stronger the impact on bond yields, and also the conceivably equities as well. But starting off with Forex, you can see here the chart of sterling dollar. Now, this was when the UK back in January announced Q4 GDP. We had a rally, a pretty strong rally actually on cable, about 100 ticks on that GDP data. So the market does move. Now, as ever, when I talk about this data, I know because a lot of traders will, a lot of retail traders will want to trade the data. Now, there's obviously different ways of doing it. Trading in front of the data, and it sort of takes on a bit of a 50-50 gamble, or you can trade just in the wake of the data and go with the data surprise. So you'd buy into the surprise or sell the surprise depending on whether it's a positive or negative. And that, I think, is sort of buying on the surprise, or is probably the way to do it, because it's the safest, I think, because it takes an element of the gamble out of it. Obviously, there's still times when you get complete turnarounds and markets retrace, and the market doesn't do what you think it should have done. Well, that is the market, I suppose. But the way to, if you're going to trade data, I would say that the safest way of doing it is to trade just after the data has been released, so that you know the direction, because the markets do tend to trend. I mean, you can see here the GDP for UK trended for a good hour in one direction before seeing a retracement. So it was you would have got a pretty strong move out of that. And for this UK data point here, you can see that certainly for positive surprises on GDP, that would suggest that GDP is improving. That would suggest that it's potentially going to be inflationary moving forward, and has an impact on monetary policy expectations in terms of the potential need to hike interest rates. So, as I said, when you get stronger data, you can that has a strong impact on the currency, and that was certainly the case here with sterling. In terms of bonds, similar sort of argument really, although it didn't seem to do that much to the 2-year Treasury yield. Now, the argument being that if you got the data point here, US GDP disappoints expectations, and subsequently impacted on bonds as sort of started selling bonds on this one. So it's not necessarily you'd argue that certainly a strong growth data should be negative for bond prices, because, as I said again, bonds are fixed income data. Fixed income. When you're sort of pushing out for inflationary expectations or increasing inflationary expectations, then bonds will suffer. Now, that didn't necessarily happen in this instance. You actually saw a very slight rebound before subsequently retracing again. So certainly the 2-year Treasury didn't really react in the proper way in this instance, but normally speaking, across normal data releases, you'd expect strong growth data to be negative for bonds and strong for yields, pulling yields higher. You could also argue, as I've put here, it will impact on yields differently across the curve, because the longer end of the curve tends to be more reactive to economic growth than the shorter end, which is more sort of in line with monetary policy expectations. Economic growth will be very much more to do with the longer term part of the curve, so therefore sort of 10 years and over will react far more normally to releases of economic growth GDP data. So here we go with equity markets now. ISM manufacturing. You had this is back in February, whereby the ISM manufacturing, which was released at 3 o'clock 3 o'clock UK time, 4 o'clock European, or 10 o'clock in the US, and we saw a reaction to the downside on the S&P 500. Not a huge amount, just 4 or 5 ticks across the space of what's this, a 1 minute chart? So yeah, it's about 6 ticks in 5-6 minutes. So you had a slight reaction, nothing too significant. But again, the market then subsequently started to turn around. But what you'll tend to find is obviously looking at the degree of the surprise is the main driver of the move. So if you'll have a significant surprise, then the market will move much more strongly in any direction. But what you can see here is ISM manufacturing mixed expectations, remaining weak, and subsequently we saw a sell-off on the S&P 500. Now, you would argue also that equity markets on a longer term basis is a difficult one to really gauge, because there are 2 different ways of looking at equity markets, aren't there? You've got the equity markets where you want to see positive great data, which is good for the economy, and generates consumer spending. Therefore, consumer-facing stocks and sectors will perform well. However, on the flip side of that, if you've got very strong growth, then that could lead to a sharp increase in interest rate expectations, and that tends to be negative for equity markets. Equity markets tend to, in interest rate tightening cycles, and equity markets tend to react less positively. So it's sort of across a medium to longer term basis, it's a difficult to really gauge, but certainly the initial reaction tends to be positive. The only sort of exception to that, I would say, is at these times when the market has been again sort of really concerned that the Fed's going to hike interest rates, and you'll get a positive data surprise. So positive data for the US increases expectations of the end of accommodative monetary policy. So it does have there are sort of different arguments to it, but it just depends on how the market at that point is looking at the data. But it's the sort of thing that you need to sort of keep an eye on and see how other data points have been reacting, and how the general mood of the market has been in the run up to that data point. And finally, gold. Gold is again very much closely linked to the US dollar. When the dollar is strengthening, you see gold weakening, and here you can see the opposite to that. So gold price has gone up after a disappointing ISM manufacturing data. Gold is seen as not only a safe haven, so disappointing manufacturing just suggests that the US economy is not performing well. Therefore, a safe haven would perform well in that environment, but also that would put downward pressure on the dollar. This disappointing manufacturing ISM data, down pressure on the dollar, and then subsequently the gold price would benefit off the back of that. And here you can see that move was seen in the subsequent move in February. Right, so let's have a look. That's the end of that series of charts. Now let's have a look at some live market data, live market information, sorry. So let's start with the euro. Euro has been very interesting recently because the longer term chart, if I zoom out, get a longer term perspective on this chart, you can see this this pivot band, 1050 to 11 figure. How many times has 1050 to 11 figure provided the pivot on this chart? Time and time and time again, it's been a key turning point, and that is the exact level that we're basically turning around at the moment. The last 5 days we've seen 1106, 1096, so within 4 ticks of 11 figure, 1120 and 1111. So that key $1.11 level is still holding, and it's not really showing any real signs yet of breaking down. Now you've got the sequence of lower highs, lower lows on this chart, but is the move now beginning to slow down? You're starting to see this RSI picking up. You're starting to see a little. This is only today, mind you, because I looked at this morning, and the chart was sort of still fairly much negatively configured, and certainly unless you'd obviously need a closing level to come at above 40, say for example on the RSI, you still haven't had any sort of buy signal on the stochastics. You've had a minor crossover, but you'd want to see those above 40, above 20 on that RSI, and you've not on the stochastics, and you've not seen that yet. So for now, I think you've got to just consider this to be another sort of sell into strength. Now that selling into strength has happened consistently. This is sort of across almost about a month now. Time and time again, you see these rallies, you see the sell-off, consolidation, minor recovery. So let's just measure how much these moves go. So that's 1180 up towards 1245. That was 60 ticks. You saw 1130 to 1215. Okay, so that was 80 odd ticks, and now you've seen 1096 up towards 1160. So again, you're sort of 80 ticks, 90 ticks, 80 ticks or so to 1173. So in the sort of scope of this being another bear market rally, this is basically it, isn't it? You look at this hourly RSI, again, you're up around sort of mid-60s, where all these rallies have tended to fall over. But as I said, it's interesting because you're starting to see the RSI on the daily chart marginally picking up. Now, if we see a close above 40, that would be a positive. If we saw, for example, the hourly RSI moving above 70, that would also be positive. So the downward pressure, as we've got back to this 11-figure level, has started to dissipate somewhat. And you could also argue that, I mean, you could have drawn in a big downtrend, but that downtrend has now been broken, and you're starting to see the move starting to sort of push higher, and certainly the selling pressure has dissipated, nowhere near as strong to the downside. But will it have the impetus to be able to create a rally? Now, the key levels to work with on the upside to signal a rally on euro dollar initially is at 1216 mark, but 1245 was that reaction high that we saw on the 23rd. I would say that is a key level. That 1216 mark pretty much was the low of these sort of lows from April. So that's interesting, isn't it? That's a pivot on this chart as well. So you've got some fairly sizable overhead resistance that you'd need to get through for the bulls to start to regain a little bit of control for a near to medium term rally. But there's a lot of overhead supply now, and it's basically at a crossroads. I think the euro, because it could well be that we're going to trade above 111 figure, but below that 12.45 level, and in front of the ECB. Because not only that, you've got all these data points that are coming towards the end of this week. You've got the ISM today, you've got the ECB tomorrow, and you've got non-farm payrolls on Friday. You've also got the ISM non-manufacturing. So 4 absolutely massive data points that can impact on euro dollar. So it's not necessarily surprising that we're failing to break through that 11 figure support. Cable has been very interesting. What a massive turnaround. But cable turned around yesterday on that's massive bearish engulfing candle. Big turnaround came on that Brexit, couple of Brexit polls that would suggest that the vote isn't as cut and dry as you'd think. So subsequently, the market sold off around about 250 ticks, and to a certain extent, it's still continue to go because it's about 35 ticks down on the day. Now we're testing this uptrend, and this uptrend is under real pressure because that's initial support of 140.40 is a higher reaction low there, and that is under big pressure, isn't it? Now what's today's traded low? 144.36. So on an intraday basis, it just sort of broke that level, but has basically sort of held on so far. But look at this daily RSI. 46 was that low that we saw in May. That was the 43.30 level. 46 again around about that level. If we see a close below 45, that would be a low dating back 6 weeks or so. You'd see the stochastics in correction mode. It would be seriously questioning how this medium-term recovery is going now. Just incredibly, basically, it's just turned around on one candle. But can one candle be the big turning point on cable? Well, at the moment, that outlook is being seriously tested. That one big bearish engulfing pattern that sort of unwound over 250 ticks on the day is having a real outlook changing moment on the on cable, but it needs to be confirmed by a break of that uptrend. RSI below 46. Ideally, you'd want to see also a confirmed break, which would be a closing break of 140.40 as well. Is there much difference on the hourly chart? Well, not really. We had the UK PMI today, which was actually fairly reasonable. I say fairly reasonable. It was above 50. 50.1 was the manufacturing PMI for the UK. 46.6 was the expectation. So it did slightly beat expectations, but still is very sort of stagnant looking economy, isn't it, the UK at the moment, or certainly according to the manufacturing sector, which is again in really struggling to sort of get itself out of the doldrums again. And subsequently, sterling's come under a bit more pressure today. But I think the ISM manufacturing data today is going to be really the focus that everyone goes on. But as I said, 44.40, which is that reaction low from the 23rd of May, is the big level. 43.30 is the key reaction low from May, which is that big May low. That would be the real support that if that were to be broken, then you're going to be back at 140 figure again. Dollar yen has broken the uptrend. Really interesting. Really interesting. This sort of sequence of higher lows has just started to accelerate to the downside. Over 100 ticks of downside now. It peaked out at 1143. 111.43. It's now almost 200 ticks down from there, and the outlook is beginning to sort of turn around again, isn't it? Having sort of been driving that recovery, the yen is strengthening. Those stochastics have turned lower. The RSI is just starting to turn lower as well. Although you'd probably say below 46 would be where you'd start to turn a bit more negative on the RSI. But certainly this run higher is putting pressure on the 109.40, sort of 109, that reaction low at 109.38. But let me just show you that on the intraday chart, because that shows better. Here you can see that sort of run of higher lows, and on that you've got 109.50 basically is a pivot line in the last sort of 2 weeks. But then obviously 109.10, which is this reaction low here on the 22nd, that is your big support now, near term. If you lose that support, then it looks like you're into some sort of serious retracement. That is the support there, 109.08 to the pip. So yeah, so dollar yen is beginning to look increasingly under pressure again, and that's unbelievably. I mean, this time yesterday we were still looking pretty positive on all these forex majors for the dollar, and now just 24 hours later we're seeing a significant turnaround. Aussie dollar, is this picking up? I mean, we're talking about the dollar weakness in the past 24 hours. Again, you've seen 2 candles in a row where we're starting to see a bit of traction. Now the candle today has just sort of arguably disappointed a bit. I mean, 73 figure was the high, and it's now sort of 40 ticks off that. So it's unwound quite a lot of the gains that it saw early on, and that came on the back of higher than expected Aussie GDP. Aussie GDP this morning, let me show you. Very strong, and subsequently we saw this big strong bull candle this morning, early doors, and a big run higher. Now, has this turned around the outlook for the Aussie? Because you look at these stochastics, they are now, well, 1 month high, but also having sort of look like they're sort of giving off that confirmed buy signal. MACD lines crossing higher, RSI confirming the stochastics improvement above 40. Is this a turnaround for the Aussie? It looks like a move above 72, say 72.60. I've got 57 here, but 72.60 ultimately is basically what we're looking at. If it can close above there, I think that's a big level. Because certainly near term seems to be a pivot line. Now 74 figure is the big resistance. So it's capped all the gains throughout 2015. It's been supportive in March on a turnaround, but look at this here, this reaction high here, 74 figure again, lower reaction high, and you've seen the run continuing to the downside. So your first real reaction high to test is that 73.66, but 74 figure, if you saw a break back above that, that would be a significant turnaround again. I think near term we're seeing an improvement, and you could argue that there's a small base pattern there on a move above 72.40, so measured from 71.40 to 72.40, you could argue 73.40 is on, and that is a recovery target near term. Show you that on the hourly chart. You can probably see that better. Here we see that sort of double bottom, 72.40. So get rid of that. 72.40, double bottom. Target 73.40. So that 72.40 is a near-term breakout, and again also supportive. Old pivot line. So maybe look to use that in a recovery, in a near-term recovery. I stress that, a near-term recovery, 72.40, because there's a lot that needs to be confirmed, although the outlook for the indicators are starting to turn around, aren't they? Certainly. Let's look at Kiwi. Kiwi's doing similar sort of things. Sorry, that's not done that. It's combined the two charts, which is annoying. So let's go NZD equals. That's better. That's better. Right, yeah. Kiwi has sort of turned around a little bit as well, isn't it? But again, I mean, I sort of talked about Kiwi in the fact that it's completed a corrective pattern. It's sort of back towards this sort of red line, which is a neckline of that top pattern. And there's arguably sort of a pivot band. So with all these reaction highs basically around that neckline. So is it going to be able to sustain this move? Is it going to be turning back lower again? Is a big overhead supply that I think we need to wait through. You'd need a close above 68.50 probably, which would be the reaction high from the 12th to really sort of suggest a sustainable turnaround. Now, I haven't got too much time left, so I'm just going to look at gold very quickly. Now, gold is an interesting one. Oh, sorry, my Fibonacci levels are wrong on gold. That's 33, 303. There you go. Right, okay. Fib levels on gold, 38.2% at 12.05. Certainly a support. That is a big support. I think between 1191, which was arguably that reaction low there, February, which was not only that reaction low, but also the October high. So 1191 is the big support. 1208 was supportive, but got slightly broken, although just has recovered back above it. So basically, gold is testing a big floor of support. And yesterday's candle was the first positive candle in 10 candles. Look, nine successive negative candles on gold. And not only that, we've lost from the 1303 high to the 1199.60 low. That's $104 in 4 weeks on gold. So the potential for a turnaround or a near-term retracement is relatively high, actually, I'd say, but it's got a load of overhead resistance now between sort of 1223, which again was a reaction high a couple of days ago, between 1223 and 1233, which was this reaction high here. I think you've got $10 worth of key resistance there near term. So that's what I'm looking at. Now let's look at that on the hourly chart. Oh, it's done it again. That's better. Is this a sustainable turnaround? Well, there's an improvement, but is it sustainable? Well, it's basically rallied to some into some resistance, isn't it? Today's high around 1220. Already, as I said, pretty much hitting that resistance at 1223. So you've got this band of overhead supply that I'd say needs to be watched, because ultimately we've seen this rally unwinding the move. Is it this beginning of a real technical turnaround? Well, you'd need to see the RSI holding above on the hourly chart. This is holding above probably at least 40, if not 50, or 48, which was that reaction low from yesterday. You'd need to see the MACD lines holding above neutral, and you'd certainly need to see the support, this reaction low, which was 1208 figure, staying intact. So if you start to lose that, all these technical factors, then I think you could see gold coming under sort of corrective pressure once again. Now that is a big floor, isn't it? Now 1191 to 1208. That is a big floor on gold, and if you see a breakdown of that, that would be a big top pattern and further correction. But my outlook generally for gold is fairly neutral, actually. Although I think it's going to remain a choppy play, and it certainly has been in 2016. You had that strong run higher, but then it basically went into a chop. You had that move higher that retraced from 1303. But again, I'm fairly neutral. I think above 1191, I think I'm sort of in a trading range. I think on gold up to sort of 13 odd, $1,300. I think it's going to be a choppy range because I think gold is a big play on the dollar, and the dollar obviously is a big play on the Fed. So the gold price will be reactive to the Fed certainly, and it's I think it's a choppy range play. Let's just look at WTI, because WTI has obviously got OPEC on Thursday. It's lost a little bit of the momentum, isn't it? But you'd argue still that rallies, little corrections are a chance to buy. At RSI around 55 seems to be a very good level to buy, which would be probably not a million miles away from that uptrend. You've had a minor sort of let's get a horizontal line. You had a minor correction. Sorry, I've got the crosshair on. Don't need that. So look, you've got this that reaction high at 46.78, 46.80, 46.75. So there's clearly a pivot around that, and that's not a million miles away from where that uptrend is going to be coming in. So I think that's a pretty key level, 46.75, 46.80. That's a key level, I think, for oil, and that is I think going to be the gauge now. OPEC coming out on Thursday, will they basically just come in and just say, well, the oil price has risen now, so we don't need to do anything? That is the big risk, I think. If they start to be lazy again, then that could have a corrective impact on oil. But watch out for that 46.75 level. Momentum indicators across the board still strong, so I think you're still trading this uptrend for now, and using the little corrections as a chance to buy. This latest one is a pretty decent correction, but yeah, that sort of nice band of support there, 46.75. Right, if I've got time, then let's just have one last look at a chart, which is the DAX. In the last, how many months, I don't know, I've been talking about these key Fibonacci levels of this big bull run, and they have come in time and time again as your key sort of turning points. And what have we seen again in the last day? Yesterday, big sell signal, which was a bearish engulfing. Yesterday continues to the downside, and that came within 7 pips of the absolute fib level, which is incredible. So again, we're seeing a turning point at that level, the fib levels. So really remarkable. These fib levels continue to do a job. You could argue that in the last sort of 2 or 3 months, these fib levels have not done such a good job. But prior to that, we saw turning points all over the place at the fib levels. This high here, this reaction low here, this reaction low here in September, this reaction high here, and again that reaction high at the fib level. So 61.8% would be 9,900 basically, which is 3% down from here. So that's sort of unwinding all these gains that we saw last week. But you look at these momentum indicators, you'd say, well, the RSI has again rolled over around 60. Stochastics have crossed lower. Last time we saw a stochastic sell signal, we saw retracement of, well, 5%, 6%. So yeah, you could certainly see this move if the momentum gets behind it. And the RSI, again, this is very much neutrally configured. RSI between sort of 40 and 60, that's neutrally configured momentum. So you'd be playing that as a range play, and within a range play, you play the mean reversion. So you'd be reverting back to the mean, which would be sort of not a million miles away from that fib level, of sort of 10,000 initially you'd say that support is at 10,120, which is this old breakout. If we got it exact, it does come in at 10,120. But then if that gets broken, then you're sort of looking at 10,000 and then sort of back towards these levels here from the May lows. So we could actually now have entered into a near-term corrective phase on the DAX. So with that in mind, is my disclaimer, and I wish you good luck in all your trading. Please read and understand the disclaimer. If you want to follow me on my Twitter, I'm at Hantec Rich, where I sort of discuss all sorts of things, boring or otherwise, market related or otherwise. Yeah, so engage with me if you'd like, and I wish you good luck in your trading, and I'll speak to you again next time. Thank you very much indeed.